Hi everyone. So I have a confession to make, which is that this paper is not about physics at all. If you Google alpha decay, all you'll find is a million physics papers. So unfortunately, this is business school, not CERN. So I'm going to be talking to you about informed traders. Right, so informed traders are a pretty essential part of financial markets. We like to think that financial markets are efficient and that prices reflect all available information, but that information has to come from somewhere. And usually we think of this information as coming from traders who are better informed than other market participants who trade in markets, and by doing so cause the price to adjust and reflect that new information. So what do we know about these informed traders? Well, unfortunately, not very much. And the reason for this I'll tell you very shortly, but let me first take you through what we do know. Firstly, we know that they probably exist. There's some theoretical arguments that suggest that informed trading has to exist in order for prices to be even resembling efficient. So theoretically it has to exist, but we have some empirical evidence suggesting that there are informed traders in the market. They tend to be a bit strategic about how they trade. They don't just go all in and buy large chunks of stock all in one go. They tend to split their orders up over multiple days into smaller chunks to presumably hide their information from the rest of the market. They're associated with higher price impact. So when informed traders are in the market, prices, if you want to trade, you're going to get a worse execution price, reflecting the information asymmetry between the information that the private informed traders have and the presumably lack of information that you have. And finally, we know that they use limit orders rather than market orders, which suggests that they are providing liquidity to the market rather than absorbing it. And they also tend to trade when noise trader activity is high, which makes them especially difficult to detect. Right, so we have a main reason for this lack of information, or at least the limited information we have about informed traders. And why do we know so little? It's because of data limitations. Right? Traders are, especially informed traders, are very loath to give up any information about their trading activity so that they can't be front-run, that they can't have their strategies reverse engineered by competitors, and so on and so forth. So the existing data sets, the most popular of which is Anserno, or Abel Noser Solutions, these data sets are voluntary. Right? These are basically informed traders for the purposes of transaction cost analysis will submit some of their trades to consultants like Anserno, who will then make that data available to academics. Right? So the main problems is that the investment firms themselves decide which trades to submit. Right? Even though we see from these trades that some of them appear to be informed, there's no guarantee we're seeing the full picture. We also don't know what their portfolios look like. Right? We only see the trades. There's another data set very similar, Plexus, which has the same problems, and also you can't track institutions over time, so we can't see how they build positions over longer periods of time. And finally, we can go to regulatory filings. These are mandatory 13D filings, but only for activist investors. Investors who want to accumulate more than 5% position in a particular stock, more than 5% of the market cap of the stock, that is, and who have an intent to influence the management of that stock, of that firm. Right, so that's a very specific type of trade and a very specific type of investor. So it doesn't tell us necessarily about the broader picture. Right, so what would we like to know? Well, we want to know fundamentally what's the relationship between informed trading and stock prices. We have a ton of theory about this, but we really don't know if that theory is true or not. Right? What does the life cycle of informed trading look like? Right? So we've previously been able to look at some informed trading over very short spaces of time to see how fund managers break their trades up into smaller trades. But how do they trade with a longer-term horizon in mind? Most fund managers have a long-term outlook. So what kind of stocks do they target? That's another important question that we don't know very much about. If they're just targeting big companies that are already very efficiently priced, is that very valuable? We don't know. And finally, what determines how aggressively the traders will act on their information? And again, we know that they tend to split up trades into smaller chunks, but do they do this more or less? Do they take larger trades? Do they influence prices more under certain conditions? And a corollary of that is what determines their profitability, right? You would think if you trade more aggressively, then you're likely to have a more profitable trade, right? Otherwise, why would you trade more aggressively? We're not sure if this is the case. So how am I going to tell you about this? We have a new data set which comes from a firm called Analytics. It's a UK-based consultancy. What they do is they act as monitors. Right? Fund managers have certain performance, and it can be difficult to figure out if they're good or bad. And pension funds especially are not necessarily equipped to make this judgment. So what they do when they hire external managers is they go to this company, Analytics, and they say, you monitor the performance of my fund managers, you tell me if they're good or not, I'll make sure that they give you access to their trades. So the pension sponsors, who are very large institutional pools of money, they have the bargaining power to force the fund managers to open their trades up for analysis by a third party. And fortunately, we managed to get our hands on that data from the third party, Analytics. One of the reasons is that one of my co-authors is the CEO of the firm. Right? So he had a lot of foresight and managed to negotiate agreements to use these data for research. Of course, all anonymized. I can't tell you who's in the sample, but we can draw some very useful conclusions about what informed trading looks like. Right? So we have almost 700 portfolios. They're long-only, traditional all-equity portfolios. We have about 200 unique fund management companies. So there are some clients who have multiple portfolios, and some of them are with different managers. Right? That's why the number of portfolios exceeds the number of managers. And we have about over 1 million orders. An order is a chunk of trades that sort of corresponds to an investment decision. And we have daily data. That's the important thing. We have trades, holdings, total assets. The sample runs throughout the early 2000s and 2010s. And the benchmarks, importantly, are specified by the by the clients themselves. Right? So the fund managers have to target a certain benchmark, and that's going to be very important for figuring out what's the right control group of stocks when we figure out what kind of properties do they target when they target stocks. Okay, so this is the paper in one graph. Right? This is what we call alpha decay. Right? So what we're doing here is we're just saying when these fund managers buy stocks, what happens to the stock after that initial purchase decision. Right? So we have to take some stance on what constitutes a new decision, and that new decision is going to be whenever there hasn't been any activity by a fund manager in a particular stock for 18 months. Now, it doesn't really matter whether we do 12 months, 18 months, it's more or less the results are the same. Right? When there's a new trade, then we track what happens to the stock every month. These are the monthly risk-adjusted returns from the date of the trade onwards. So we can see in the first month after the trade, these are the red bars, the individual month's alpha being adjusted for size, value, and momentum. The alpha is about 40 basis points in the first month, and then it declines roughly according to a power function and becomes sort of insignificant around month 12. On the sell side, when fund managers buy stocks, we don't see the same pattern. In fact, we see the alphas on the stocks become positive after the trade, which is bad for the fund manager. Of course, if you sell a stock, you would want the alpha to be negative. Otherwise, your risk-adjusted, benchmark-adjusted performance is going to look worse. So we've got to try and figure out what is going on here, but I'm going to, in the interest of time, restrict my presentation to what's going on here and just give you a very short summary. We think that this is liquidity costs. Okay, this is alpha decay. And so stocks purchased by informed traders earn risk-adjusted returns, but the alpha decays over about 12 months. So whether that 12 months is long or short depends a lot on your perspective. For academics, this is a long time, right? We are schooled to believe in the efficient markets hypothesis, where stock prices should adjust immediately, instantaneously even, to new information. But for practitioners, this is a pretty short time. When you ask a practitioner, how long do you think you can predict stock returns for? They'll say, well, we might not be able to predict them in the short run, but give us 5 or 10 years, and we know how to identify the underpriced, the stocks with real value. Unfortunately, that doesn't seem to be the case. Even despite the long holding period in our data, 2.2 years rather, the alpha only lasts for about 12 months, and most of it is gone after 2 or 3 months. So we're trying to figure out how to reconcile this information. So what do fund managers do when they're faced with these sort of price dynamics? So what we're plotting here is the intensity of trading by the same fund manager in the same stock over time. So remember, there's an 18-month period with no purchases. Then they buy a stock. Then what do they do in that same stock in the subsequent days and months? Right, so we're plotting days here on the x-axis. And on the y-axis, this is the fraction of fund managers who trade again on a given day. Right, so about 8% in the first week after the initial trade will trade again in the same stock. And then this intensity declines as we go out. After about 18 months, it goes down to about only 1% of fund managers on any given day. Now that's only half the story. What happens conditional on a trade? When they do trade, how large are the trades? How aggressively do they trade? And that's what this graph plots, right? So the red line is sales, and the black line is purchases. So after an initial purchase, they will buy again, and they'll buy again with a high intensity in the first few days after the initial trade. That intensity will decline as well over about 12 months, reaching 0, which means going below 0 means they start selling again. Right, so they're basically continuing to buy the stock for as long as the alpha is still there. Right. Then once it's gone, they start unwinding the position. Now when they unwind positions, this is the sell, they also do so extremely slowly. So this can, in some sense, reconcile that bit of a paradox we saw in the previous slide, which is that fund managers have these longer holding periods, but the alpha is only around for 12 months. What actually seems to be going on is that, well, they do trade with the right time horizon in mind, but it takes them a long time to unwind the position. If you add up these two graphs, you get about 2.2 years. Right? So let's go a little bit further and ask, what are these fund managers doing? What stocks are they targeting? So we're just going to run a logit regression, which tells us about the probability of a purchase of a stock related to certain stock characteristics. So the things I really want to point out here is that this is the fraction of fund managers who have a negative and significant or a positive and significant loading on that particular stock characteristic. So what this means, if you just focus on the red highlighted numbers, that they tend to focus more on small stocks, on stocks with low past returns, stocks with low volume, and high volatility. Right? So what are these? These are the more obscure stocks. Right? So that's the answer to one of these questions that we wanted to ask in the beginning. What type of stocks do they target? Well, they target the stocks about which there is not a lot of information already. They seem to be beneficial in terms of adding information to the marketplace. Now, are these traders really informed? They may just be benefiting from certain predictable patterns that we know that follow from these stock characteristics. We already know small stocks have high returns. We know stocks, for example, that have high past returns also have high future returns. Now, some fund managers may be loading up on high past returns, even though the average manager is not, and this could explain some of that alpha that we see. So if we run a regression where we look at all the alpha in the months after the trade, controlling for all of these stock characteristics, we see the same pattern. Right? The magnitudes are a little lower, but there's still a high alpha in the first month, declining and becoming insignificant around month 12. These bars here represent the confidence interval. So if the bar is above 0, that means it's a statistically significant result. So we know they seem to be informed, or at least they do better than you would expect after risk adjusting and after accounting for stock characteristics. Now, what determines how aggressively they trade? Well, this is where the theory has a lot to say, but we don't have a lot of empirical evidence. Game theory predicts that informed traders will face competing incentives. So first of all, if you trade more aggressively, you risk revealing your information. You put in a large trade, your counterparty will say, that person wouldn't have traded so much if they didn't know anything. What do they know that I don't? And so I'm going to raise the price if it's a buy, for example, or lower the price if it's a sell. On the other hand, if you trade slowly, you risk being beaten to the punch by competitors. Right? So you have to sort of balance these two considerations when deciding to trade. At least this is the theory. We have no idea if fund managers actually do this. So do they do this? Well, the intuition is that more potential competitors and lower levels of disagreement, right, should mean that there's more likelihood that you will be beaten to the punch, and so your trading should be more aggressive, and the profitability should be lower. Lower because there are more traders competing for the same information. So we're going to measure potential competitors by the number of analysts, stock analysts, sell-side analysts covering the stock. This is just a proxy for the amount of attention being paid to the stock. And a large number of analysts means a bigger pool of potential competitors. And we're going to measure disagreement using the dispersion in their forecasts about the stock price. So what do we find? Well, if we look at trading aggressiveness related to analyst coverage, in the first quarter after the trade, we're looking at the follow-up trading. So the first trade in the sequence and all the trades that happen in the first quarter tend to be much more aggressive, so that's the positive number, depending on, doesn't matter which control variables we use, much more aggressive if there are more analysts covering the stock. Right? In subsequent quarters, they seem to be less aggressive. And the way we interpret this is that the trading is being shifted forward in time. Trades that would have been made later are now being made earlier in response to this increased threat of competition. The forecast dispersion goes exactly the same way that we would expect, except there doesn't seem to be a reversal. So remember, the number is negative because more disagreement should relate in higher trading, in lower trading aggressiveness. Right? So more agreement should relate to more aggressive trading. So that's exactly what we find here. If there's more disagreement, they can take their time and they don't have to reveal their information to the marketplace. The trade profitability goes in the opposite direction. So if there are more analysts, the trades are less profitable, controlling for all other stock characteristics, of course. And the effect also declines as we go further out. So this is the first quarter after the trade, second, third, and then the rest. So the way we interpret that is that the information is really concentrated around that date of the trade, the initial date of the start of the sequence, and that's where we start to see the profitability being affected. Now the same thing goes for this should be the dispersion, not the analyst coverage. The dispersion also goes in that same direction. The more disagreement there is, the higher the profitability of the trade. Right? So the more agreement there is, the lower the profitability. More traders are competing for the same information. They're all trading more aggressively, and their profitability is subsequently lower. So to conclude, informed traders take their time when accumulating positions, and they're mindful of potential competition. They seem to pay attention to strategic considerations in the marketplace. They also target more obscure stocks, so they're doing a service to the market in creating information about companies that there isn't a lot of information about to begin with. And disagreement among these traders can explain why stock prices don't adjust immediately. All right, so why does the efficient markets hypothesis not hold in this case? Well, because the informed traders don't have a very strong incentive in most cases, because there's just a lot of disagreement about what should be the correct value of that stock. With that, I'm done. Hope you enjoyed it.